Class, a pleasant day to all of you. This is your Professor Dan, and in this video, we are going to discuss incremental analysis. And basically, incremental analysis is more on cost effectiveness analysis. Okay? Plus, the topic is describe management's decision making process, concept, and types of incremental analysis, and the three important cost concepts. Okay, and the specific lessons are one, what is decision making process and the concept of incremental analysis? Second, what are the three important cost concepts? And third, what are the types of incremental analysis? Okay, let us start the discussion. Okay, management's decision making process. Making decisions is an important management function. It does not always follow a set pattern because decisions vary significantly in scope, urgency, and importance. However, there are steps, okay, in the process. So the first one is we have to identify the problem and assign responsibility. Okay, when we speak of assigning responsibility, we have to identify the person who is responsible. Okay, and second, determine and evaluate possible courses of action. So you have to determine the alternatives, okay, for this problem. And third, you have to make a decision. Of course, the decision will be which alternative is best. And lastly, review results of the decision. Okay? In making business decisions, management considers both financial and non-financial information. Financial information related to revenues and cost and their effect on the company's overall profitability. And non-financial information relates to such factors as the effect of the decision on the employee, environment, and image of the company. Okay, let us continue. Oh, by the way, when we speak of financial information, it is more of performing a quantitative analysis. And quantitative analysis means that we will do the analysis based on numbers, or we will make a decisions based on whatever the number is in your analysis. Okay? We will illustrate this in the succeeding slide. Non-financial information is more of performing a qualitative analysis. Okay. So incremental analysis. Now we are discussing the concept. Incremental analysis is part of the decision-making process, which is primarily focused on the quantitative factors of the alternative courses of action. The quantitative factors on the incremental analysis are in terms of revenue, cost, and profit of each alternative course of action. Incremental analysis is also the process used to identify the financial data that change. Under alternative courses of action, examples are, so class take note, the financial data that change. Okay? The change in sales revenue of the alternatives. So we have to identify what are the changes in sales revenue of the alternatives. Next, the change in cost, both variable and fixed costs of the alternatives. Okay? In performing the evaluation of the courses of action, the basic considerations are, so if we will perform already a decision, Okay, so in incremental analysis, since that it is based on quantitative factors, so the first one is which alternative provides a higher profit if you are comparing alternatives based on their profit. Obviously, you have to choose the alternative with higher profit. And if you are comparing the alternatives based on revenue, then you have to choose an alternative with higher revenue. Then, if you are evaluating the alternatives based on their cost, you will choose which alternative provides the least cost. Okay? So basically, these are the measure in which we will uh, choose the alternative. In incremental analysis of cost, it is important to consider the incremental variable cost and fixed cost of each alternative courses of action. Okay? So, because class, in general, variable costs vary with activities and units of production. We have learned that if the production increases, then variable cost will likewise increase. Okay? And then there can be certain alternatives, okay, that may require the same variable cost even at different activities. Okay, take note, class, in incremental analysis, there is a possibility that though variable costs vary with the number of units of production or with the activities, then there can be situation wherein variable cost will be the same at different activities. We have to take note of this. Fixed cost, on the other hand, is considered fixed. However, in certain incremental analysis, like a rental expense, which is fixed, can become an incremental cost in a decision whether to continue occupancy of the building or to purchase or lease new building. Okay? So you have to take note of these things. Let us continue the concept. Though incremental analysis is focused primarily on quantitative factors that affect the decision, the qualitative factors of the courses of action are not ignored in incremental analysis. Many of the decisions involving incremental analysis have important qualitative factors. Example, on the make or buy decision or of the decision to eliminate a line of business. The qualitative factors are the effect on the existing employees and the community in which the plant is located. It can also probably have an implications on the other services or other products. So you have to consider all of these qualitative factors. Okay, let us have an illustration, okay, about the basic incremental analysis. Given Great Plant Company is considering the following alternatives. Alternative A, alternative B, and these are the data of each alternative in terms of revenue, variable cost, and fixed cost. Okay? And we are going to perform an incremental analysis. Okay, based on what we're given, wherein we have revenue and variable cost, our incremental analysis is we can determine the alternative with higher gross profit. Okay, so based on what we're given, you can determine what particular um, incremental analysis that you need to perform. So in this case, okay, let us have an analysis of the gross profit of each alternative. So we have our revenue and we have learned that in doing a gross profit, revenue, less cost of goods sold, and our cost of goods sold are variable cost and fixed cost using the absorption costing. So we have here the variable cost of 350,000 based on what was given and fixed cost of 140,000 for a total cost of goods sold of 490,000. So revenue less cost of goods sold will give you your gross profit of 60,000. And on alternative B, our revenue is 540,000, variable cost of 330,000, fixed cost of 140,000 for a total of 470,000 and a gross profit of 70,000. By merely looking at these two alternatives, we can already conclude that alternative B provides a higher profit by 10,000. So here, we can already make a conclusion between these two alternatives based on gross profit, okay, because we did the incremental analysis based on gross profit. So the decision is alternative B. It provides higher gross profit by 10,000 compared with alternative A. Okay? However, class, in incremental analysis, we are actually looking at the incremental values. How are we going to perform the determining the incremental values? So, first is that we will compare A with B. Okay, comparing A with B. So, the here A has 550,000 revenue and B has 540,000. So our comparison is that we will uh, get the value of A and deduct the value of B. So in this case, 550,000 minus 540,000. There is a 10,000 difference. And we are saying here that in terms of revenue, alternative A has higher revenue. Okay? And then for its cost, alternative A has 490,000 and alternative B has 470,000. So 490,000 minus 470,000. So A has a higher cost of goods sold by 20,000. So 10,000 minus, because cost of goods sold has to be deducted from revenue, minus 20,000, we will have a negative of 10,000. So it means that A gross profit is less by 10,000 compared with B. However, if we will do this incremental analysis, where in B, we will compare it with A. So in this case, B, 540,000 minus 550,000. There is a negative of 10,000. So here we are saying that in terms of revenue, B has a lower revenue by 10,000. Okay? So for cost of goods sold, 470,000 minus 490,000 will give you a negative of 20,000. Meaning in terms of cost of goods sold, B has a lower cost of goods sold by 20,000. So doing the mathematical calculation, negative 10,000 minus negative 20,000, you will have positive 10,000. Here, class, if you will recall your algebra, because we are deducting minus 20, minus negative 20,000, so it means that minus and minus would mean positive. Okay, okay, just review your algebra and you will know what I'm trying to say. Okay, so in this case, you will note that B has a higher profit in the amount of 10,000, which is what we have just made a decision, okay, that alternative B is better. Okay, let us move on. Let us discuss the three important cost concepts. First is relevant cost. In incremental analysis, the only factor to be considered are those costs and revenues that differ across alternatives. So, meaning if the cost and revenues are the same on each alternative, we don't have to consider that. It's only those costs and revenues that differ. Okay? Second, opportunity cost or opportunity income. This is the potential benefit that may be obtained but will be lost by following a course of action. Okay? So, an example, if machine is used to make one type of product, the benefit of making another type of product with that machine is lost. Oh, here, in this case, the lost benefit is referred to as opportunity cost. We will explain this in illustrations, okay, in the succeeding slides. If potential benefit can be realized by following an alternative course of action, this can be an opportunity income. So you can treat it either cost or an income depending on the situation. Sunk cost. Sunk costs are costs that have already been incurred and will not be changed or avoided by any present or future decisions. Okay? Example, the amount you spent in the past to purchase or repair a laptop have no bearing on your decision whether to buy a new laptop. Okay? So, meaning that if you have incurred such particular expense or cost, then those costs are already sunk, meaning it's no longer important in the decision process in the incremental analysis. Okay, sunk costs are not relevant cost. Okay, so class, the three important cost concepts: relevant cost, opportunity cost, and sunk cost. Okay, relevant costs are those costs that you have to consider. Opportunity costs are those costs that you need to consider in the incremental analysis as well. But sunk costs, you don't have to consider that in the incremental analysis. Okay, now let us discuss the types of incremental analysis. These types of incremental analysis, we will do an illustration on the succeeding lecture video. The relevant profit and our cost have to be analyzed in performing the incremental analysis on the following. The first incremental analysis is this: whether to accept an order at a special price. Here, we will evaluate, okay? We will perform an analysis of the profit, okay, of that special offer, of that special price, okay? A company has an opportunity to obtain additional business if it is willing to make a price concession, which means reduction of price to a specific customer, okay? Next, we will have we will perform we will do an illustration of this type of incremental analysis, the make or buy. Okay, whether we are going to make a certain part of our finished product or we will just buy that part of our finished product. Okay, so here we are going to perform an analysis of cost between making a particular part or buying that particular part. When a manufacturer assembles component parts in producing a finished product, management must decide whether to make or buy that particular component. Example, Hewlett Packard Corporation may make or buy the electronic circuitry or cases or printer heads for its printers, okay? Because the printer consists of several parts. And the company may choose to make it on their own or just buy it uh, from other supplier. Okay. Next is sell or process further. Okay. We will have to do incremental analysis whether we have to sell or process further. In this case, we are going to make an analysis of the revenue. We are going to make an analysis of the revenue, cost, and profit between sell or process. Many manufacturers have the option of selling products at a given point in the production cycle or continuing to process and selling it at a higher price. Example, bicycle manufacturer could sell its bicycles to retailers either unassembled or assembled. So here class, selling it as unassembled or process it further as assembled. Okay? The sell or process further decision should be made on the basis of incremental analysis. So the decision rule on the incremental analysis is that you can process it further, it is beneficial to process it further as long as the incremental revenue from such processing exceeds the incremental processing cost. Okay? Next is repair, retain, or replace equipment. In this, you are going to perform an incremental analysis of cost between repair, retain, or replace the equipment. Management often has to decide whether to continue using an asset, repair it, or replace it. Example, Delta Airlines must decide whether to replace old jets with new, more fuel efficient ones. So, the costs to be considered in incremental analysis are the variable manufacturing cost or operating cost of the asset, okay? The cost of the new equipment, the trade-in allowance or cash disposal value of existing asset. Trade-in allowance is that how much is the value of your current assets if you are going to sell it or meaning trade it, okay? So that is the cash disposal value or the trade-in allowance. We also have to consider the book value of the old machine. But this, take note, this book value is what you call a sunk cost, okay? Which is a cost that cannot be changed by any present or future decision. Class, the book value is the original if we have an old machine, okay? So the book value is what is recorded in the record. The cost of the old machine minus the depreciation, the accumulated depreciation of the old machine, that will be your book value. Those costs are already sunk because you have already uh, paid the original cost and then you have already incurred the accumulated depreciation. So those values are already sunk cost, which you will no longer consider in your future decision. However, class, if you are going to sell that old machine, then what that would be your cash disposal value of that old machine, and it has to be considered, okay, only when it is sold and it has a fair market value. I would like to emphasize that the fair market value is not necessarily the book value. If, for example, the book value of the machine is 80,000, but in the market there is a willing buyer for that old machine, and that particular buyer would like to purchase it or buy it at 50,000, then the fair market value can be placed at 50,000. Okay? And that fair market value is an important component in your incremental analysis. So here, class, I would like to emphasize that a sunk costs are not relevant in incremental analysis. Next is eliminate an unprofitable segment or product. Here, class, we need to perform quantitative analysis of revenue, cost, and profit between segments or products. Okay? And it can be more than one segment or products. It can be two or multi segments or products. So we need to do a quantitative analysis. However, it is very, very important on this elimination of unprofitable segment or product, the qualitative analysis of alternatives. Okay, qualitative, we have um, discussed this, that qualitative would mean the implications on the existing products or services of the company, the image of the company, the implications on the personnel or employees of the company, and on the community that the company is operating at. Okay? Management sometimes must decide whether to eliminate an unprofitable business segment or product, or which segment or product to eliminate if management has several alternatives of eliminating unprofitable business or segment. If there are two or more alternatives, the key is to focus on the relevant cost under the alternative courses of action. Relevant cost, which means that costs that vary between the alternatives. Like in this example, airlines to quit servicing certain cities or cut back on the number of flights. Then the company has to determine which flight, okay, that is more advisable or acceptable to the company based on the quantitative and qualitative analysis. Management considers the qualitative effects of eliminating unprofitable segment, that is, its effect on the other product lines, customers, market, company's image, employees, and community. Okay, class, that is it for this video, and have a great day. Stay safe, class.